Reading from the title of this video, you're watching because you're curious about dividends. What are dividends? How do they profit? And what are some strategies that have a good yield in dividend investing? Stick around with us if you want answers to these questions. To be finance savvy, Financial Intellect is your buddy, so what are you waiting for? Like, subscribe, and click the notification bell to be updated whenever we post a video. What are dividends? I know you might be thinking, why invest in dividends? Well, many of us would definitely feel intimidated by its seemingly complicated term, and some of you might suggest that investing instead in real estate is a better source of passive income. But hear us out before you leave. You might be judging this a bit too fast, and there's no indication that it's declining. It's true that shelter is one of the most basic and important necessities for everyone. I do agree that the value in investing in real estate keeps rising, and the income earned from this totally accommodates your needs and wants. You can even use this as your home whenever you're in a tight spot financially. Even during crises such as the COVID-19 pandemic, there's no significant decline in the revenue generated from real estate. On the contrary, there was actually a 17% increase in prices. However, the seemingly passive income generated from this investing method masks the reality when it comes to real estate. How exactly, you may be asking? In real estate, you have to invest your time and effort. Apart from the cost of repairs, utility bills, and maintenance of your property, you also have to find a good tenant that would be trustworthy, who would ensure the integrity of your property, and be punctual when it comes to paying their rent. And all of these require all of your attention and focus to ensure that your property is of utmost quality, and if not at par with, then maybe better than the standards of other competitors in terms of the property's physical condition, legal records, maintenance, and in other aspects too. And this is where dividends sound a bit more compelling, since unlike real estate, dividends are the real deal, the real passive income. Why? It's only about searching for that particular company that would be consistent and would profit more, and then the rest is history. You'll earn money while doing nothing. Sounds like a dream, right? Well, it's actually true, and many people are venturing into this investment right at this very moment. What is dividend yield? To further understand how dividends return your money, let's first learn about dividend yield. Dividend yield is a percentage of how much a company pays out in dividends annually relative to its stock price. Knowing this, you might be thinking that having a high dividend yield would give a high return on the stock price. However, this is not true all of the time. In fact, a yield that has a relatively higher value than other stocks may entail not a good dividend at all. This can result in a dividend cut, or in the worst case, removing dividends altogether. As such, when looking into dividend yield, don't be allured by how enticing the yield is. Rather, look into how high quality the company is, such as considering its history of paying dividends. What is dividend payout ratio? Aside from dividend yield, we also have a dividend payout ratio. This is the proportion of company earnings allocated to paying dividends. This also presents how the source of dividend profitability works hand in hand with company growth. But how do dividends profit? Companies take a long time in order to experience financial growth, and it often needs investments from people or companies to be able to execute their projects, from research and development to sales. Or they might need a place for their employees to work. Despite the long waiting, the sooner they begin to make a profit, they split that profit with the company's owners, which could be you. As a result, if you purchase a stock, the corporation is compelled to share the benefit with you. This is referred to as a dividend. For instance, consider investing in a company that pays a 3% dividend per share. One share of the corporation is worth $100 and you hold one. As the company makes money, your dividends would be $3. However, not all businesses, particularly those in the field of tech development, pay dividends. They'd rather return that money back to the company to use it for other investments that will give them ROI, or return of investment, a lot quicker. Stable corporations with little room for growth, such as Nestle, Coca-Cola, L'Oreal, and others, divide their profits with their shareholders. Companies like Amazon, on the other hand, face a lot of competition, so they never use their profit for paying shareholders and instead benefit them by maintaining a high stock price. To find out how much a firm pays in dividends, simply Google the stock price of that company and look at the dividend yield. For example, Apple is paying 0.53% for each share. So, to put it in simpler terms, Apple pays $0.22 per share of stock you own every 3 months since it's the quarterly dividend amount. Whether or not this is high enough for you is up to your own understanding of dividends and the number of stocks you own. Meaning to say, the more shares you own, the more you earn in dividends once these stocks profit. However, there are also factors that can affect the changes in dividend yield, and the most recent that had the greatest impact is the pandemic, because since its onset, the Federal Reserve has cut the interest rate and bought corporate bonds, causing the prices of stocks to rise significantly. Their dividend yields decreased because as the prices doubled, the dividends remained unchanged. Going back before the pandemic happened, Apple, for example, paid a dividend yield of 2.5%, so that for every $1,000 invested in Apple, you would get $2.5 in dividends. That number, however, does not appear to be as high when you compare it to real estate earnings. However, you should keep in mind that when you invest in dividend stocks, you also gain once the stock soars up. Apple has not only paid dividends, but also increased the value of its shares by 1,156% in the last 10 years, far more than real estate investors can hope for. However, there are corporations who are known as the king of dividends, referring to the 31 companies that remained at the top in terms of sustaining the constant increase in their annual dividends despite financial turbulences and drastic changes in the market. Johnson & Johnson is one of these companies. They have kept their dividends rising for 59 years. Currently, their annual dividend yield is at 2.58%, which pays $4.28 a year. This also means that if you own $100 worth of stock of Johnson & Johnson, you'll be receiving an annual dividend payment of $2,578 while also benefiting from the increase in stock prices. Now, here's a list of top 10 from the king of dividends, companies that managed to keep their dividends increasing for the past years. Are dividends safe? Before you decide to invest your money, you should also make sure that the company will most likely keep paying dividends at the same rate or even higher. This is why people opt to buy stocks from already established companies, no matter how high the price, because they can sleep soundly at night knowing that their money is safely making its move. For instance, if a corporation generates $100 million and pays out $90 million in dividends, you'll profit more than if it only pays out $30 million in dividends. However, if it pays out $90 million in dividends and profits decrease by 10%, it will be difficult to continue paying shareholders at this high rate. As a result of lower dividends, your income is reduced. How risky or new an industry is also a factor in dividend safety. Even if a company has a low dividend payout ratio, if the industry isn't reliable, your dividend payment will be at risk. Look for companies with a history of consistent revenue and cash flow. Strategies for dividend investing. Giving a lot of attention to a high dividend yield approach or a high dividend growth rate strategy is a good technique that most wealthy dividend investors do. So what are these two? The first approach is through a high dividend yield. Here, you'll target companies that have gradual growth but with a high cash flow. It sounds so easy to find, right? But don't let this trick you. Companies with a high dividend yield may have a hidden reason for it. It may be investors trying to avoid the shares because of the threat of the dividend being cut, or the company is in a tight spot. Remember this, financial buddies. Don't let the dividend yields fool you, as they can sometimes be illusions to trap you. So with this, how would we find companies with high dividend stocks without taking that much risk? Well, you're in luck, since we have the answers for you. First, ensure that the dividend payout ratio doesn't go beyond the threshold between 60% to 70%, meaning the company still has between 30% to 40% revenue from expanding its business. Second, invest in companies that have pricing power, wherein the company can manipulate the prices whenever there is inflation and ensures that your dividend account is still able to earn despite how much the government is printing money. Third, search for stocks that have a debt-to-equity ratio of less than 1.0. This guarantees that a company has at least $1 of net worth for every dollar in debt. In financial terms, this phenomenon is called capitalization structure. And finally, find stocks that have a price-earning ratio of 15 or less. This would establish a sort of safety net in the case that a dividend is cut off. Aside from this, another approach we can follow is the high dividend growth approach. Here, you'll be targeting companies that pay low dividends but are fast growing. you'll be able to purchase profitable stocks at a lower percentage while generating lots of revenue over a 5 or 10-year period. This strategy involves a more passive way of earning money compared to its high dividend yield counterpart, since it provides a steady stream of passive income which does not rely on abrupt growth in the price of the stock. And as a bonus for you, financial buddies, we would like to share some strategies you can combine with the dividend growth approach. First, try to establish a network of shares in many major companies which increase their dividends at a rate equal to or has an excess of inflation for every year. Second, this may be a tough one, but hold your positions longer, which may take decades in order to take advantage of deferred. This would mean that you will have more capital and more dividends to be received by your family. Third, just like any other investment, in general, try to diversify your dividend stream, which would not focus on only one area of the economy in order to avoid being too reliant on this particular field. Fourth, ensure that the dividend growth is backed by real earnings and not debt. And lastly, similar to what we have been saying in our previous advice to not focus on a single industry or sector, try to diversify your dividend stream by investing in different countries, which would allow you to collect dividends with multiple currencies. This way, you also ensure that you still get your share from other investments even if a country's market value comes falling. So, are you guys ready to start investing in dividends? If you like the content we shared with you, please consider liking and subscribing to our channel. And if you want, you can hit the notification bell button under this video so we bring you only the latest and most accurate tips and techniques and the know-hows of managing and doubling your finances. Feel free to comment down below any suggestions or questions and we'll be ready to respond to them. See you again in the next video.